Good day, everyone. If you are new here, welcome to this channel, and we hope you are going to have an exciting moment and learn new things here. And for our subscriber, welcome to this episode. So, today we are going to be talking about risk and the concept of risk and insurance. We have, the essence of this channel is to talk about insurance, and something comes before insurance. It is risk. So, what is risk? Risk is uncertainty, a possibility of something bad happening in the future. It has not happened, but it is possible it will happen. And sometimes risks also come as a possibility of gain. It's not always all the time that it's going to be something bad. So risk is something that is not certain. Risk is something that can happen, bad that can happen in the future. So for risk is perceived by different people and in different ways. And before I go into that, I want to tell you that risk means different things to different people. For a doctor, what risk is to a doctor is probably the risk of not losing one of his patients. To a parent, what risk is to his children or to his or her children is to ensure that nothing bad happens to my children. To a car owner, risk may mean I don't want my car damaged. So risk comes in different perspective. Now we have different kind of people. We have a risk averse person. A risk averse person is somebody that don't even want to take risks at all. Someone that want to push their risks to the next person, to anything, so that when the risk happen, they are not affected. And also we have a risk taker. They don't even mind. They want the risk to come and they are ready to deal with it, because some people feel that when they hire the risk, they hire the return. So a risk needs to be identified first, because sometimes we don't even know what can happen. But as an individual, there's a need for you to sit down and analyze the risks that can happen, the bad thing, the good things that can happen to you in the future. And when this is identified, there is a need for you to evaluate, measure this risk, and you need to take a decision that when you are measuring this risk, that okay, when this risk happen, how bad is it going to affect me? Is it something that is going to keep me going? For a business owner, a risk is you don't want to go bankrupt. So you need to analyze what are the things that can happen to you that can make you go bankrupt. So when this is identified and you measure it, you are able to evaluate it. Then at that time, you decide on how to manage that risk. So in managing the risks, and that is where insurance comes in. Insurance is one of the instruments you use to manage your risk. So it's a kind of, you're going to transfer your risk to another person. You have noticed that if this risk comes to you, it may wreck you and you may not even be able to go back to your stand again. So in doing that, in order not for you to go bad or something, you look for an insurance company that you are going to transfer your risks to. So now takes us to insurance. Insurance has a lot of processes. So if you want to look at insurance, I think like I said, we have 3 processes for insurance, which is identification. A risk you have not identified, you cannot insure. So the first thing you need to do is you need to know this is the risk that exists, that will happen, that may happen. You are not sure it's going to happen, but you feel it may happen. So the risk is already identified. So after you have identified your risk, you need to measure the risk and know what are the losses that can come when this risk happen. The loss must be measurable. It cannot just be a random thing. It cannot be, because when a risk is measurable, it helps the insurance company to put a value, to put a premium to the risk that is identified. So at that point, you now know how to control the risk. In fact, for a good underwriter, there are several ways that you can control risk. If it may not even be by transferring risk, you may be advised that okay, you need to do this to prevent this from happening. So, and that is where an analyst comes in. So So they advise you on, okay, even if you are going to push this risk to an insurance company, there are measures that you need to take in order to prevent this risk from happening. Because we all know that even if you have insurance and this risk happen, the period of inconvenience can be taken care of by you even preventing this loss from happening. So it now takes us to the big question: what are the insurable risks? Is it every risk that you can reinsure? Like I said in my introduction, risk is the possibility of you having a loss or you having a gain. Now, is it all these risks that are insurable? No. For a risk to be insurable, it has to be a financial risk. A risk that when it happens, there should be a financial loss. So if you have a risk that may lead to you either gaining or losing, that risk is not insurable. Like you want to go and do gambling is not insurable. But if you have a property can be damaged, and when it is damaged, there is no likelihood for you to make money from a damaged property. So that risk is insurable. Then it has to be a pure risk. It has to be a loss that is pure. There should be no possibility of gain. There should be no possibility of you making money out of the risk that is happening. Then it has to be a particular risk. In my last one of my episodes, I was talking about in those days when people feel insurance company don't pay claims. People feel that once you buy insurance, if any damage comes, the insurance should repair and should reinstate them. But that will not work, because for insurance there is a particular peril that is covered. So now you have a vehicle and you buy a fire cover. The peril is fire. Now tomorrow, because in your mind you know that you have insurance, tomorrow your car is stolen. You are not coming back to insurance company. I have insurance, my car is stolen. Come and pay me back the money. It doesn't work that way, because that particular risk, which is theft, was not covered. You didn't buy that cover. So it has to be a particular risk. And for a risk, and another characteristic that we need to know about risk is that a risk has to be uncertain. Anything that is certain is not insurable. So I cannot wake up one day and say, today I'm going to have an accident. No, it's not certain that, but I may likely have an accident. So that is what makes it insurable. So another thing that we need to talk about is, for a risk to be insurable, it has to be an homogeneous risk. You can't insure a risk that is standalone, because insurance is a pool. For motor insurance, we have different cars, so we can put all the motor inside a pool, so that when there is a loss of a particular vehicle, the insurance take care of it. So you cannot do a risk that is standalone on insurance cover. Okay, so the fourth one is, you don't insure against public policy. And what this means is that you cannot just go and insure a criminal act, like probably you're going to steal and that is going to lead to a liability. No, that is not insurable. So anything that is against public policy, it is not insurable. So we want to talk about what insurance entails. Number one, there are some key things that we look at in insurance. Number one, and I think I've been stressing this, uncertainty. Insurance does not deal with anything that we are sure is going to happen. It has to be a game of probability, a chances of something bad happening. So that is one of the concepts of insurance. Then number two, we have perils and we have hazard. Now, what's the difference between peril and hazard? A peril are actually the loss, what caused the loss. Why hazard is what influenced the loss. Now, I'll give you an example of peril. A peril is fire, theft, is liability. A peril is... So example of perils, there are fire, there are lightning, there are explosions, there are flood, there are strike, riot, and civil commotion. So there are a lot of things that entails in a peril. So now, if you're buying an insurance cover, you're buying a cover against a particular peril. So you need to know what peril that can cause a loss. If you're staying in a place that is not susceptible to flood, you don't need a flood cover. So when you're buying an insurance cover, you can tell your underwriter that no, I don't need flood. My place is not susceptible to flood. But if you know that you are staying where there is a gas plant that can be an explosion, then you need to know at that point that you need a fire cover. So those are the things that guide you in buying your insurance cover. Now, what are hazard? We have moral hazard and we have physical hazard. For an accidental cover for a motor, if somebody that is reckless in driving, that person is a high risk person, and the moral hazard is that if the person is reckless, he may likely have an accident. So these are the things that you need to know. But for somebody that is so cautious that does not drive, probably your limit is 80 kilometer per hour, 60 kilometer per hour, you know that that person is a low risk person. So that helps in measuring the loss that can occur as a result of that, and that is a moral hazard. Physical hazard for a fire property, let's say a building. You all know that a building that is made of wood, if there is fire, there will be no salvage, because the hazard is that that wood will catch fire and the fire will even spread all over. But for a house that is made of cement and there are a kind of things, there are fire extinguisher, you know that at least even if the fire happens, there is a limit to which the fire can go, because there are precautions that can limit the spread of the fire. So that is what hazard is all about. Now we talk about the risk frequency and risk severity. You all know that there are some risks that we know that it will happen. Look at motor now. In a day on Nigerian road, you can be sure in some road maybe that there must be an accident. So for that risk, we know that the frequency is high. But for an aircraft, in Nigeria, I think for past years, we've not heard of a plane crash. So that is, but if there is a plane crash, the loss is always very huge. So that is loss severity, because the loss will be severe. But for a motor insurance, it's going to be frequency, but the severity is going to be low. So all these are what an insurer take into consideration when they are determining the premium of a risk. So if you find this video helpful, kindly subscribe, like, and share. So see you in the next episode. Bye.